The market won't always go up. So the real question isn't what if it turns, it's are you prepared when it does? Every experienced investor knows this. Markets are cyclical. There will always be ups and there will always be downturns. So when someone asks what happens when the market turns, that's actually the right question. Because strong deals aren't built for perfect conditions. They're built to withstand imperfect ones. So here's what we do. First, assume things won't go perfectly. Before we ever buy a property, we ask what could go wrong, not in a pessimistic, cynical way, but in a professional risk management way. For example, what if rents grow slower than expected? Or what if vacancy increases? Or what if interest rates rise? We look at all of those scenarios. We don't underwrite for the best case scenario, we plan for the realistic case. Second, we stress test the deal. We take the numbers and ask, okay, if things get worse, does this still work? For example, what if rents only grow half as fast? Or what if occupancy drops by 10%? And what if exit prices are lower than expected? If the deal only works in a perfect scenario, it's not a strong deal. Good deals survive bad scenarios. Third, buying right matters more than timing the market. One of the biggest misconceptions is trying to time the market perfectly. In reality, your protection comes from how you buy, not guessing the future. We focus on buying below replacement cost, strong locations with long-term demand, properties with operational upside, and conservative financing. You make your money when you buy, not just when you sell. Number 4, cash flow provides stability. In multifamily real estate, income doesn't disappear overnight. People still need a place to live. So even in softer markets, properties can continue generating income, and that income helps support distributions, which is money in your pocket, and gives flexibility to hold through a volatile period. Cash flow acts as a buffer, not a guarantee, but a layer of protection. 5, long-term strategy versus short-term noise. Syndications are typically long-term investments, and that matters because short-term market shifts don't always impact long-term outcomes. If the market softens, you don't have to sell immediately. You can hold and wait for recovery. You can adjust strategy as needed. We don't invest for the next 6 months. We invest for the full cycle. 6, experience matters most in down markets. Here's the truth that most people don't realize. The real test of a deal isn't how it performs in a strong market. It's how the team handles a challenging one. That's why experience matters. You want a team that has navigated different market cycles and has had to adjust their strategies when needed, all while communicating clearly with investors during the whole thing. Because when things get uncertain, execution matters more than projections. When the market turns, here's what matters: conservative underwriting, strong market fundamentals, cash flowing assets, a long-term strategy, and experienced operators. The goal isn't to avoid every downturn, it's to be positioned to handle one. Market cycles are normal, they're expected, and when deals are structured properly, they're something that you can navigate, not fear. If you want to learn more about how I evaluate deals and manage risk, join my investor list using the link below. I share opportunities, insights, and exactly how we think through scenarios just like this. And if this video was helpful to you, hit subscribe.